$8 billion disappeared, and no one saw a crime scene. No hack, no breach, no warning alarm revealed the loss. The money moved quietly inside a system without rules. A $32 billion empire collapsed in just a few days. Celebrities promoted it, and politicians accepted donations. Customers trusted FTX more than regulated banks. Regulators met the founder, but oversight never arrived. What vanished was not stolen, it was never protected. The system works like this. When rules are late, money moves. Sam Bankman-Fried was not selling coins, he was selling trust. Alameda Research exploited price gaps starting in 2017. FTX launched 2 years later, controlling both sides of crypto. One company held deposits, the other traded against the market. No law stopped a trader from running a trading platform. Traditional finance requires separation. Crypto did not. Innovation moved faster than regulation could respond. The system works like this. Loopholes become business models. FTX sold the idea of safety instead of selling crypto. Stadiums carried its name, and stars vouched for its security. Millions trusted the platform because famous names did. Politicians welcomed donations and praised its vision. Sam spoke about regulation while none restricted him. Confidence replaced oversight, and checks were ignored. FTX acted like a bank without following bank rules. It moved money like a broker without disclosures. It lent funds without licenses or customer safeguards. Most users never knew they were unprotected. The collapse begins. Software-controlled assets instead of financial regulations. Code gave Alameda unlimited borrowing from customer deposits. Terms promised assets belonged to users. The code overruled it. Billions moved because the software allowed it, not the law, not hacking, not theft, simply rules built into code. The system works like this. Technology becomes regulation. Customer funds financed risky bets, political gifts, and real estate. Alameda CEO Caroline Ellison confirmed they borrowed from FTX. By 2022, they owed $13 billion in customer deposits. A single document exposed the illusion of protection. A leaked balance sheet showed assets built on FTT tokens. Collateral was a coin FTX created and valued itself. Traditional finance bans lending against invented collateral. Crypto had no rules stopping it, so FTX approved it. FTT was worth belief, not independent value or reserves. Alameda borrowed billions against confidence instead of capital. A tweet from Binance triggered a market panic overnight. Binance planned to sell $500 million in FTT. Customers rushed to withdraw $6 billion in 3 days. Banks have insurance, crypto exchanges had no protection. Regulated markets pause, unregulated ones collapse instantly. Withdrawals failed because deposits had already been spent. It looked like a bank run with none of the safety. Binance reviewed FTX books and walked away from a rescue. The hole was roughly $8 billion and growing. Investors refused, regulators could not act fast enough. The collapse became legal, not financial intervention. The system works like this. Oversight arrives after damage. On November 11th, FTX and 100 companies filed bankruptcy. Customers lost funds not because crypto failed, but law did. Who is accountable in the aftermath? John Ray, who handled Enron, took control of FTX. He reported the worst corporate controls he had ever seen. No board oversight, no risk management, no accounting system. Billions tracked with QuickBooks and casual chat approvals. It was not complex fraud. It was unsupervised finance. Sam was arrested, extradited, and charged with 7 crimes. His closest team testified that code replaced regulation. In 2024, Sam received a 25-year sentence and $11 billion forfeiture. Punishment did not close the regulatory gap that enabled FTX. Crypto still operates where law has not fully defined it. Exchanges act like banks without custody requirements. Platforms issue tokens behaving like securities without filings. Lending happens without licenses or consumer protection. The system works like this. Markets grow where law is silent. Regulation reacts. Collapse arrives first, legislation later. What did FTX really prove? FTX showed how finance becomes dangerous when definitions are late. One platform acted like every institution, without protections. It stored deposits like a bank without bank laws. It traded assets like a broker without audits. It lent like a lender without licenses. It created tokens without securities regulation. When everything is possible, nothing is protected. Customers assumed safety because money was involved. They assumed endorsement meant verification. They assumed hearings meant supervision, not discussion. No agency took full responsibility for oversight. FTX acted first, waiting for rules to catch up. The system works like this. Gaps become profitable markets. New rules are promised now, but markets move faster. Technology evolves before laws are written to contain it. Crypto is global, while rules are written for single nations. The collapse did not close loopholes, it revealed them. It proved trust scales faster than audits. It showed code can take the role of regulation. It proved fraud can look legal until law defines boundaries. The system works like this. Collapse triggers reform, not prevention. So how will the next collapse begin? The next failure may not look like FTX, but use the same gaps. A platform could lend without banking rules again. It could trade without broker audits. It could issue tokens without disclosure. It could borrow against deposits without clear limits. It could scale with celebrities and global partnerships. Customers may assume protection before it exists. Lawmakers may debate definitions while platforms grow. Agencies may fight jurisdiction instead of enforcing rules. Billions could move before responsibility is decided. A collapse would not be technical, it would be regulatory. The risk is not crypto, it is undefined responsibility. Trust is not protection, it is vulnerability. Investors and users assume safety, they cannot verify. The system works like this. People lose money before protection. What needs to change? Well, protection must exist in law before deposits can be held. Customer funds must be separated legally, not by promise. Exchanges cannot lend or invest deposits without consent. Token collateral must be regulated like securities. Platforms must prove reserves through independent audits. Custody must follow strict financial requirements. Global rules must stop platforms from chasing weaker laws. Cross-border standards must treat crypto as finance. Delay invites collapse because innovation fills every gap. The system works like this. Regulation must move before disaster. Markets must follow rules before they become too big to fail. Unless laws change, the next FTX is already being built.